into CrossFit.
Oh, did you?
Mhm.
I hear that's expensive, CrossFit.
It can be. I
Yeah.
mean, good things are never cheap at the end of the day. I guess that's the best way I can put it.
Yeah.
But
Do you
yeah,
like CrossFit?
recently started getting into that. I
Do you
do.
like it?
It's coaching, which I really like. I like being told what to do.
Yeah. Yeah.
At the end of the day.
Well, it
See,
keeps you
do I have this
accountable too, I
guy?
feel like.
It does. It really does. Nick, how we doing, sir? Thanks for joining.
Yeah, no problem. Doing well, you?
What's this? Looks like we are live. I'm gonna share it to the Make It Have a Multifamily group. Bring that going. Shelly, thanks for joining. There we go. Everybody see my screen? Yeah, feels good. Pin myself to the top just so that I'm always there. Does everybody know Russell? This is Russell Dog, Russell Dior. We have matching hoodies, by the way. I also have a blue hoodie that is the exact same hoodie. And every Friday I do a monthly post about Russell. Yeah, he's famous. Facebook
Russell.
videos.
It looks
Tell him
sophisticated.
Russell Hart's the best in real estate. Right. Right. Who's got the best win of the day out there? Anybody want to share a win of the day? This is an interactive webinar, by the way. It's not just like some presentation where Lee just delivers the news or lives a talk.
Um,
Nobody wants to share a big win of the day.
yeah, I've got a win for you. We got an LOI sent
Mhm.
out. It's a big win.
Boom. There we go. Which one is this? Is this uh the one in Missouri that we're going after?
Yeah, the Collins Point, Ozark.
Boom. There we go. Oh no, I'm gonna get which one is this? Is this the one in Missouri that we're going after? Is that
Yeah, the Collins Point, Ozark.
boom? There we go. Oh no, I'm gonna get which one is this? Is this the or am I the only one hearing the double?
I hear it. It's looping.
This is like
Yeah, I can hear it.
Missouri this is super weird.
Yeah, the Collins Point, Ozark.
Really well. There we go. Oh no, I'm gonna get which one is this? Is this or am I the only one hearing the double?
I hear it. It's looping.
Okay, I think we should. Did we fix it? All right, we can get to the actual presentation. What are we seeing here? Start over. All right, everybody see my screen? Yeah. All right.
Yep.
All right. I'll let people in as we go, but all right. The non-partition rule. Okay, cool. All right, let's kick it off. And I'll start letting people in as they continue to join. My name is Lee, and welcome to another edition of Make It Happen Multifamily's webinar series. What we do each month is we gather on the second Tuesday of every month at 7 p.m. Central live to be able to gather and cover a specific subject of focus each month. This month's subject of focus is going to be debt, loans, how interest rates and loan types shape real estate investments. It is the most, there's always the most important thing. Like property management is the most important thing. Asset management is the most important thing. Raising capital is the most important thing. But understanding your loan is the most important thing. Because there's so many different most important things. But it can literally make or break your deal at the end of the day. So yeah, just get into it and I'll introduce myself so that you can understand where I'm coming from and why you should be willing to think of me as a thought leader in the industry. So today, yeah, we're focusing on debt, how interest rates. Today, we are lifting the hood on how money works in real estate and understand the wealth of multifamily investing. And you have to understand the role of debt. My name is Lee. I'm the founder of Green Forest Capital and Make It Happen Multifamily. Make It Happen Multifamily is our thought leadership platform. We have over 3,600 members of our Make It Happen multifamily group. And of course, we also have Green Forest Capital, my multifamily real estate syndication business as well. So in a gist, I started with a duplex in 2000. Actually, I started as a property manager 2012. Over the course of the next 13 years, I've now owned $80 million worth of multifamily housing in primarily Missouri and Arkansas. I've done a few deals outside of St. Louis area as well. And my big goal for these monthly webinars is to book calls with you and be able to have conversations about investing in real estate and help you in any way, shape, or form that I possibly can. I bring with me a wealth of knowledge of everything from single family houses to 100, 200 plus unit apartment complexes, and love adding value to the universe as a whole. So, even if you're not immediately ready to passively invest in your first deal or whatever the other case might be, let's jump on a call. Let's get to know each other. So at the end of the day, I always like to start these out by talking about the benefits of multifamily. It is a known, I mean, maybe not for everyone, but for me, it is known that multifamily is much more scalable than single family houses. Anybody in this room can go out or watching us live or watching a recording can go out and buy a single family house on their own by themselves. You can save up your down payment. You can house hack or move into one room and rent out the other or whatever. But the economies of scale really kick in that, call it 20 plus units, ideally even 100 plus units. So you can really take advantage of scale by buying, large scale portion, material. You can hire full-time on-site manager. There's, just so many ways to reduce the risk of your real estate investment by buying larger deals and ideally with better better partners, stronger partners, so that you have everybody brings value to the team, and you bring in people with certain strengths. Like, for example, I've got Megan and Morgan here. They are absolute killers in the residential real estate brokerage space in California. They are awesome at marketing. I'll tell you, Megan is absolutely a star at marketing. She develops awesome flyers and marketing packages and you name it, designs our websites and so on and so forth for all of our larger communities. And I'll tell you, she does it 10 times better than I ever would be able to in probably half the time. So that's just one example of so many different values that people bring to our team. Like, for example, we've got Dave here on the far right leaning on Sam. Dave has, I think, 25 years in commercial multifamily construction and development in his background. He's the guy walking around the property with the clipboard in his hand, making sure that all the young guys are actually doing their jobs. And I'll tell you, you don't get the opportunity, or you won't be able to have the opportunity to do business with true professionals in the industry unless you have a property or a portfolio that is large enough, to make it worth it for all of us to be able to participate in the business. So the greater whole, the whole of the team is greater than any one of us individually. So yeah, commercial real estate, and I like to specifically focus currently on multifamily. So today's agenda, we are going to cover the four major loan types used in multifamily and commercial real estate. We're going to discuss how the loan structure affects your returns, and investors' returns are directly correlated to the debt that's in place on the property. And in many cases, they don't have a choice of what type of debt they put on it if you are a passive investor, because they leave it to the sponsor to go out and pick that for them for their deal. So how rising and falling rates shape real estate deals along the way. And it give you multiple real world examples of loan scenarios that we have utilized for deals in past, present, and future projects. So, and also, what does how does the market affect your loan, and what the Fed's decision really ends up taking into effect on your given real estate debt product that you have on your property. So your debt strategy for your deal is literally one of the key factors, I would say three major factors as to whether or not you're a success or failure. Really, I was taught a long time ago by some really amazing guys, Gino Barbaro, and Jake Cinziano, and I learned from them the three-legged stool. You have manage right, and then you have finance right, and then you have it's buy right. So buy right, finance right, manage right. And if you don't have all three of those legs of that stool, you're gonna have a wobbly stool. So yeah, but one can make up for the other if you do have that, but you're gonna be a little off. So the strength of your debt is going to determine the strength of your deal. It amplifies both risk and return. As your debt changes, it can increase your cash flows. It can increase your returns. It can also increase your risk if you have higher amount of debt service or debt payments, or if you are overextended and over leveraged on your deal. All right. The wrong loan can kill your deal, and the right loan can unlock value. Having low cost, long term fixed interest debt with long periods of interest only on it will change the entire return structure of a deal versus the exact opposite, something that is floating rate where if interest rates rise, then the deal could completely fall apart and you might not be able to even service your debt. And for passive investors, you need to understand the loan terms for the project that you're investing into. You can't just trust and let somebody else go and put whatever kind of debt they think is right on it. I think that you have to have an understanding of the debt, not because it is one of the key three factors of the success for any deal. Finance right. So there are four loan types that we're going to talk about in today's discussion. Who here has been a part of a deal that utilizes or has utilized an agency loan? Agency loan? Yeah, thumbs up out there from the crowd. All right. Well, agency loans are a very common loan type in multifamily. It is when I learned originally about the terms of an agency loan, it changed my entire outlook on real estate investing as a whole. The fact that you can essentially get unlimited numbers of loans on your property is a huge win. Like you can continue to leverage your net worth and a new assets cash flows and net operating income against itself multiple times over. You're not just limited to like 10 loans or how much your net worth is. They are also usually low cost. You usually have a very low interest rate associated with them. We're going to go into each one of these in a little bit more detail as well. But we're also going to cover bridge loans. Usually they are floating rate, short term, best used for extreme construction, heavy lift projects where you are kicking people out. They are a bridge from purchase to stabilized loans. They're a bridge to a future loan type, ideally like an agency loan or maybe a longer term bank loan. We're going to cover bank loans. I love bank loans. I love regional banks. If you don't have a great relationship with a regional banker in your market where you're buying, if you don't have at least 5 of them to call, pick up the phone, call them right now, today, you need to go out and get yourself set up with a relationship with 5 lenders local to your market, wherever that is. I don't really care whether it's, Albuquerque or St. Louis or anywhere. And if you're going to look in multiple markets, you need to have multiple banker relationships in each market that you're choosing. So because most regional banks don't loan in across the entire nation. That's what agency loans would probably be best for. But we're also going to cover private non-recourse debt funds. This is kind of a fun one. Anybody heard of like hard money? Yeah, we understand hard money concepts where a private person will actually loan you the capital you need in order to purchase the property. do have
Oh, we gotta wait. We ain't
and
playing
they
with
are
niggas. We going to the
fantastic.
mix. Hold on, Bert. I gotta get close. I get my miss. Ain't nothing wrong. I gotta switch. Do the go.
Okay, well, there we go. Sorry. So yeah, there are private non-recourse debt funds out there these days that are really helpful for investors to be able to utilize as an it's essentially another product that's very similar to bridge loan. All right, so who has questions so far? So far, so good. We're plugging right along. Anybody have any questions, comments, concerns? Just like a interactive webinar, not some, webinar where you're just sitting there listening. All right, I'll keep going. Feel free to jump in. Feel free to jump in. All right, so agency loans. So we are, this is my favorite type of loan. We are always looking to be able to either acquire a property with an agency loan or refinance into an agency loan. So they are meant for stabilized assets, properties that are all next done to them. They are properties that are truly quality financeable assets. Why do we love Freddie Mac and Fannie Mae loans, agency loans? Well, because they carry with them a lower interest rate. These loans are tied directly to the 10-year treasury. So if anybody is ever wondering, like, why just prior to closing does every single buyer constantly and always talk about the friggin' 10-year treasury? It's because the rate that their loan is going to end up being is based purely on what rate is currently on the market for a 10-year treasury note on the day they rate lock their loan. And I think last time I checked, the 10-year was at like 4.1, right? So approximately 4.1. Most stabilized properties, 90% occupied for 90 days in good markets, carry with it around 125 basis points spread above the 10-year on the loan. So if the 10-year goes from 4.1 to 4.0, your rate is going to directly drop by 10 basis points. And your rate that you're going to pay, if the current rate is 4.1, is going to be probably about 5.35, add 1.25 percentage points or 125 basis points on top of whatever rate the 10-year is on the day you rate lock your loan. So that's how that works. So you are locking in your rate. It is also a non-recourse loan. So if you were to fall into a place where your property is insolvent, they cannot go after your personal assets. And that flows not only from the investors, but also to the general partners as well. So it truly ties the loan directly to the asset. The worst case scenario for everyone is that they can take the property back. But if you own a single family house with a personal guaranteed mortgage on it, if you fail on that mortgage payment, they're not only going to take the house, but they're also going to come take your car. They're going to garnish your wages, so on and so forth. They can't come after your plane, whatever. So, yeah, the non-recourse is a beautiful thing and also allows you, that is really what allows you the ability to continue to borrow and borrow more and more and more money because the loan is purely fixed and focused on the asset and not just how much your total net worth is and income, like no income to debt ratio is required on that level. There are liquidity requirements, there are net worth requirements, but that's another subject, and I can answer questions about that later if anybody has one, or even now. All right. It also usually on these properties, they have nice long interest only periods. Well, why would someone only want to do, or why would someone want interest only period?
To be profitable or more profitable because the debt service is cheaper?
I would argue that you're about the same profit because you would normally be paying down the principal of your loan, but your cash flow is high because you're not feeding into equity, you're pulling more money out of the deal, which drastically increases your internal rate of return because it gives you the opportunity to take those cash flows as opposed to socking it away as paid off principal. You can pull it out of the deal and you can reinvest it into anything and everything you might want. Does that make sense? Cool. All
Hey
right.
Lee,
So interest
Sam,
only
Sam
is
here. Can you hear me?
yeah,
How you
I can
doing?
hear you.
What
Doing good, sir.
what is the criteria for an agency loan for the GPs that are signing on a loan? It's more equity and also you've got to be pretty liquid. Is that correct?
Right. So they want to see 10% of the loan amount on hand as liquid assets at all times. So if you've got a $10 million loan, they want to see $1 million in liquidity in your accounts. And that's not like checking account, savings account. That does include it's stock investment accounts, but not retirement restricted account.
And then your asset base.
Yeah, your net worth. They do want to see that your net worth is combined between the general partners or signing partners, equaled or greater than the total loan amount, ideally as well. Like, actually, it's pretty much a requirement.
Thank you.
My pleasure. Yeah, and those signing on the loan, the KP key principal is rewarded on the team in exchange for signing on the loan and providing that liquidity needed for the deal during the duration and ownership of said deal. And yes, the liquidity requirement does stay in place during the ownership of the property. All right, so yeah, solid borrower history and underwriting, everything we just talked about. And then this is ideal. This loan product is ideal for predictable and lower risk deals. We tend to do more lower risk deals. So we tend to do longer term fixed rate agency loans. All right, I really like this this visualization of the bridge loan as a concept for what it is. So
Haley, sorry to cut
are
you
we
off
doing?
really quick. Before we move into
Yeah.
bridge loans with
Hmm.
the agency loans, is
Yeah.
there a cap rate like criteria involved in this? It sounded like a low cap rate type of loan, but maybe you could speak to
So
that a little bit.
it's not cap rate specific. It is debt service coverage ratio constrained, which essentially the best way for me to describe it is you have your net operating income, which we have a slide on this later, but we can jump into it. You have your net operating income, and then you have your debt service. So if you take your net operating income and you divide it by your debt service, that is what your DSCR is, debt service coverage ratio. And the minimum that they're requiring today, last I checked, is a 1.25 debt service coverage ratio. So that would mean that if your loan is $1 million a year, you need to be netting $1,250,000, if that makes sense. 1.25. So you need to be netting 125 in order to be rationally, conservatively able to pay the loan on of $1 million. Does that make sense?
Yes, sir. Thank you.
Yeah. Yeah. The other factor, of course, is loan to purchase as well. And that is something that is actually based on the property's geography. Does it qualify for low income housing or low income credits? Not like actual tax credits, but they actually give you loan credits, surprisingly enough, like rate reductions for buying properties like that. So, all right, we'll move on to bridge loans. All right, so bridge loans are meant for repositioning very, very distressed properties. I'm talking about properties that you're going to buy and you're going to kick 100% of the tenants out and you're going to totally gut the property, do all new everything, then lease it to all brand new nice tenants at double the rates that it used to be at, and then go and plan to immediately, as soon as you are able, refinance into a longer term debt product. Does that make sense? So imagine this. And the one thing that people don't utilize when they are using bridge debt are what this picture visualizes. So this guy has two, not just one, but two safety people up there ready to catch him if he falls. I'm talking about like reach out, grab him, whatever. Save him. This guy has no harness on, at least it doesn't look like it. Well, actually, no, I take that back. He has a rope. He's being kept onto it, but he is walking, tightrope walking from a unstabilized property in or unstabilized, project or walking across into what would be the long-term lending option. Imagine this being like a big Freddie Mac or Fannie Mae sign as opposed to whatever unit credit is. He's probably walking away from unit credit. Unit credit is probably a bridge loan lender, and he's walking towards an agency loan. So, but this guy has in place exactly what he needs. But imagine if you took out a bridge loan and you were walking across a tightrope and you did not have your pole, you didn't have a strong team to keep you balanced, you didn't have a rope hanging down from you to catch you if you fall. I'm talking about having a lot of liquidity set aside and also having a rate cap on your loan. And then multiple people to help catch you if you were to fall. This is only for experienced operators who know 100% that their deal is going to be successful and is going to end up resulting in a massive increase in value. That's the only type of time that you should be utilizing bridge loans because they carry a lot of risk. And that's where many operators misused these loans and have gotten into a lot of trouble as of late, losing money back to the bridge loan lender. Anybody have questions about bridge loans? Key factors: speed, flexibility, high leverage, high risk. They're not debt service coverage ratio constrained at all, or at least minimally. Yeah, just have to show that you can service the debt. In some cases, it's crazy. They'll actually lend you additional cash to pay the interest on their loan. So it's like a self-licking ice cream cone, if that makes sense, with some of these loans. I've never done a bridge loan, just to be clear. Bank loans. This is this is my favorite way to buy a deal in out the gate. You start with a property that needs a light amount of value add. You buy it with a shorter term amortization, or you buy it with a shorter term business plan where you can actually go and use construction financing to go and improve the property and not have to trade equity for capital on every dollar for the lift of the project, if that makes sense. So it's great for either first time sponsors or deals with a nice amount of value add, or deals where even that you are, that your conservative underwriting is dialed because you are signing on this loan full recourse. So the deal is going to be successful and you're going to do whatever it takes to make sure that it does. Requires the relationship, like we talked about when we first kind of jumped on here earlier. You need to have those relationships with these small regional banks established before you're writing offers. So if you're going to go out and you're going to make offers on any deals, you need to have those banking relationships figured out. You need to make sure that they are actually looking to do business with you. Make sure that you are providing them with the types of properties that they are interested in loaning on. It's a symbiotic relationship, and you're going to make sure that you're going to get the best possible terms by having multiple lenders to be able to turn to when you do have that project under LOI or under contract. All right. It is a shorter term amortization, but usually we do rely on, nice 2 to 3 year interest only periods there in the front end to be able to help with the cash flows. The rates are usually about another 50 to 75 basis points higher, or 0.75% more than a normal an agency loan. So that agency loan, if the 10 years at 4, agency loan is at 5.25. Well, bank loans are going to be at 6. So you can pay 6% with your bank loan. You can pay 5.25 with your agency loan. so on and so forth. It is not scalable. It's a great stepping stone. Why is it not scalable? Because eventually a bank is going to run out of capital that they can loan to you. You're going to end up in a scenario where you have so much bank debt that other banks look at what you have on loan with those other lenders and they're going to say, you have way too much recourse debt out there. We aren't going to continue to loan you money. You need to go find somebody else to sign on this loan or whatever the case might be. So it's not unlimited resource like agency loans can be. All right, this is kind of a fun one. I wanted to also add in that there's other loan types as well out there, but we've got private capital, insurance companies, CMBS loans. So private capital loans are for short-term funding and special situations. I'm talking about pref equity, where you bridge a gap on your equity portion, usually they're without taking or trading equity for capital. It's for when you have an asset with, a very interesting situation. Like I was recently bidding on a deal in Arkansas where it was a bank-owned project and they knew the property would not be truly financeable, so you had to be able to prove that you could buy the property for cash. Yes, this was a $7 million property. And yes, they did expect for someone to buy the property with cash and show that that cash was sitting in a bank account or in some sort of a liquid, closable, or saleable asset like stocks in order for you to be approved to bid on the property. So it is actually something that does happen. But you can prove that you can buy it, but then turn to one of these private capital lenders and they can bridge the gap. It's like hard money. Rates are insanely high, 8 to 12%, sometimes higher than that. But when you need speed like that, I don't care. Well, if that's the case and you don't have that just sitting in your bank account, well, you're gonna need only with paying that like 8 to 14% interest rate for so long. All right. There are other types of loans out there. There are HUD loans. HUD loans are really interesting because they are fully amortizing. You can eventually pay them down to zero. USDA, United States Department of Agriculture loans, usually those are loans that are given to properties in more rural areas, obviously, like farm, if farm workers need housing, well, there are USDA backed loans that they have in the marketplace for those types of properties. There are life insurance companies and other insurance companies that do loans as well. And then you also have commercial mortgage-backed securities, which, if you don't know what that is, that's when multiple mortgages are packaged into one single asset that is then traded and sold on the open market. But we didn't have time to go into detail on all of those today. We did want to kind of cover them very briefly. All right, I'm starting to get a little into the weeds. Does anybody have any questions before we keep moving on? No? Okay, we'll keep trucking. All right, key debt terms every investor should know. I'm talking about whether you are the sponsor, you're buying a JV on your own, or you are a private, passive investor. You need to understand these key debt terms so that you can be asking the right questions and also speaking more intelligently when you're having conversations with lenders and brokers and and investors and everyone. So first one that's really important to cover is loan to value. Loan to value is the percentage of the purchase price that will be covered by the debt. So if you have a $10 million property that you buy and you put $8 million worth of debt on it, you now have an 80% loan to value purchase on that property or loan on the property. We covered this just a minute ago. We've got debt DSCR or debt service coverage ratio. Debt service is basically whether or not you're going to be paid the loan. If you have a debt service coverage ratio of 1, that means that your debt is, call it $1 million a year, and your net operating income is $1 million a year. Now, you can see bridge loans or bank loans in some cases are okay with a 1-to-1 AR, because They were able to determine how much of a loan can we put on this property, which then also in cases determines the future actual value of the property is. I think my computer died there for a second. Did we lose everybody? Back? Yes.
We're still here.
Yep.
All right. Can you see my screen?
Yeah.
Like the screen's
Yes.
up? All right. Just want to make sure before I keep going. All right. And second view, content only, close. There we go. All right, now I'm back. Now I'm viewing it the way that I normally do. All right. IO or interest only period. That's the period usually on the front end of the loan where the lender understands that you do have a business plan where like your NOI will increase, whether that's through rent increases or decreasing expenses. But usually it is a period where they want you to be able to focus on that and also be able to reinvest cash flows back into the property. So on many of our loans, let's see, we just took out a 5-year loan on a deal, and it had 2 years worth of IO. So 2 of the 5 years will be interest only period, and it drastically increases the cash flows because you're not leaving that cash in the deal as dead equity that you can't then turn around and reinvest into another asset. All right. Amortization. That is the period of time your loan is paid off in. The shorter amortization, the higher your principal payments will be each month. And the cash flows are going to be pay off the property, the less interest you will pay. So if you are a long-term hold investor who wants eventually to pay off your property and owe nobody a single dollar, and then you would want the shortest possible amortization period you can stand. You just want to continue to pay off that loan as fast as you could. So everybody has their way of their favorite flavor of ice cream when it comes to debt. And lower amortization, faster payoff, you pay less interest, saves you a lot of money in the long run. Or, you can do no amortization with interest only. All right. Now you have fixed floating rates. So, oh yes, there are loans bridged with the spot rate of 5, 7, and 10, tens and hundreds of millions of dollars worth of treasury bonds are sold every single day. It's how we create money. At the end of the day, that's literally the process of how money is created, is by creating loans that then are put into the open market. And we, real estate owner operators, are the foundation of the creation of all of the inflation that happens in the marketplace. That kind of rhymed. Kind of happy with that. So we've recently faced a period of time last year, basically since like essentially all of like 2023 and 2024, we had skyrocketing interest rates, or at least it felt that way. The demand for the treasury bonds decreased. The interest rate for those increased, and therefore the cost of 2021, we took out a loan for a property at 3.48% fixed interest for 10 years. When you factor in inflation, that's basically free money. Of course, it was, right in the middle of COVID, very low cost debt period of time and a quarter. And so like a full, whatever, what's that? Almost 200. It's like 175 basis points or 1.75% higher or like basically 50% more. The interest rate is 50% higher than what it was in 2021. And at one point in time, I mean, this is down right now. We're actually down a point higher at one point in time. So it basically doubled interest rates. So if that were to happen, fixed versus floating, if you have fixed interest rate and the rates go up, doesn't really matter. My payment stays the same. I keep paying exactly what I told you I would pay. But if you have a floating rate loan, your rate will increase unless you spend money on a cap, a rate cap, which we'll get into in a little bit, or can in a moment. All right. I like this picture when it comes to floating versus fixed. If you are someone who is willing to take the risk of riding the wave of low interest, like riding the wave of rates and going up and down in the wave of the rates, if you're cool with just constantly kind of figuring it out along the way, you don't, and you believe interest rates are going to go down, or you're willing to pay the price if it goes up, and you're going to surf the wave of interest rates, good on you. That's not me. I'm not willing to take that risk. I don't trust that process enough. I am not a surfer of rates. I want to sit on the same exact rate, steady, slow, steady, constant all the time. But you can win. You can win the day pretty reasonably. Like right now, if you took out a floating rate loan with like a very low spread, you're probably spreading yourself, or you're probably happy every day as your interest rate continues to go down. So yeah, fixed, it's safer, predictable, great in high rate environments. Floating, you have a lower spread, you have a lower entry rate, but because the risk is lower, but the risk of rising costs is directly associated with your loan. You can go out and purchase at additional cost a rate cap. It's like insurance on rates increasing so you buy a rate cap in order to lock in your loan. But usually those are very short-term rate caps. I'm talking about like maybe 3 years. Sometimes you get a couple extensions that the extensions magically they don't approve somehow if you really need it. It can happen, but your rate cap is something that you need to purchase if as insurance, it's like buying life insurance for the surfer. Buy life insurance at the end of the day if you're going to be the surfer. All right. But in today's market, it might be smart. It might, could theoretically, if you were a betting man. If I were a betting man, I would bet that rates are going to go down over the course of the next 5 years. So if you bet that rates will go down from today, then buying a floating rate loan and not fixing in your debt while it's high would probably be a good idea if you're willing to do that. All right, let's see. What happens when rates go down? Well, when rates go down, and this is the grand effect of the Federal Reserve and the cost of the 10-year Treasury and so on and so forth. So lower rates equals lower debt costs, which means higher cash flow, and your DSCR improves because your payment goes down to service the loan of the same dollar amount. You can pay more. You can pay more for the property, if that makes sense, because the cost of your debt is decreased. So everybody understand that general concept? Yes.
Yeah.
Perfect.
Yes.
I'm getting some nods. Yeah. All right. All right. Virtual nods. I love it. All right. Lower cap rates happen when interest rates go down. They are essentially directly associated because you have an industry spread between debt cost and the rate of your net operating income, which is the spread of risk. And your spread will increase and decrease based on the asset class type that you're investing in. The higher the risk, the wider you want your spread to be. So if you're going to go, that's why if interest rates are 5, if you're buying C-class properties, you probably want to be buying those at like a cap or like a 7.5, like a 250 basis point rate spread between your cap rate, if that makes sense. Where a brand new property, I mean, you might be willing to have that spread be much lower because the risk is lower on a brand new property. So maybe your spread is only 50 basis points above spread. So if rates are 5, you might be willing to pay buy a property at a 5.5 cap rate or even in some cases even below. Like there are deals right now that are trading at a cap rate below what the interest rate is. How do you do that? Is well, you put a higher down payment on it, and you decrease the amount of leverage that you utilize to purchase the property. So your DSCR is still in alignment. Your debt to purchase is much lower. So like 60% loan to purchase versus 80% loan to purchase. All right. Refinancing becomes more attractive. So as interest rates continue to fall, those who put high cost debt on their properties are going to think to themselves, I should probably go ahead and lock in a new loan on my property because interest rates are lower than what I'm paying currently, and I can decrease my payment and increase my cash flow. So you're going to have a lot of people who make that decision when rates or if rates ever do come back down. Demand for real estate surges when debt is lower for that exact reason that I kind of went into on the cap rates. As debt costs less, demand for real estate increases, and it's a fluid connection. And investors will benefit from stronger returns because cash flows will be increased, and cash flows directly affect your internal rate of return, as opposed to, your average annual return. We like to use IRR because it's how quickly your money is increasing in value and, doubling at the end of the day is the goal. So yeah, lower rates, better cash flow, better return. That's what, keep going. All right. So how do we approach debt at Green Forest Capital? We prefer agency loans and bank loans, ideally in that 70, no more than 80% loan to value. We do loan to value purchases in some cases, where we'll do like a bank loan at 80% of the purchase as well as 80% of the capex. Like that's what we did with the Main Street Apartments property, the one behind me in the photo. So yeah, that is our preferred business model is actually that. It's to buy with bank debt, utilizing a small amount of construction financing from the bank lender, and having an 80% loan to value total at the purchase, and then improve the value of the property, ideally by decreasing expenses, increasing income, ideally in ways that don't require spending a ton of money on capex. You really like value add doesn't necessarily need to be going in and spending $20,000 on every apartment. Just renewing an existing tenant who's paying $1,100 to $1,250, I would say is just so much better and so much more cost-effective way to increase the value of your property versus going in and kicking out a tenant who's paying $1,100 and spending $10,000 to get $1,250. So you're much better off just leaving them in there at $1,200 and not spending the 10 grand renovating their apartment. So then the next stage in that process, ideally for us, is refinance into agency, where we on a long-term debt product that is perfectly placed and perfectly built for long-term ownership. So yeah, that's our normal standard business plan. And no, we don't like floating rate bridge debt. Never have done it. Never will do it. Ever. Just, it's I just haven't found a deal. Yeah. Private debt. I have used, private debt in placement of purchase debt as well as for equity. It's only with specific people, but I do like borrowing money from private investors or private folks as well, beyond just, banks and bridge lenders. Usually we're, paying out in that, call it 10 to 12% range, depending on the property that people are investing in. And you'd be surprised how many investors are quite fine with getting, 10 to 12% annually, as opposed to, and having it paid out current, as opposed to having it be based there purely on the success of the, yeah, we have a strong preference for predictable investor cash flow, and that holds true when you utilize long-term fixed interest debt. And then, yeah, we're always stress testing the deal as we go along in order to make sure that we can can survive even the harshest of storms. All right, Jaron, I saw you raise your hand. Go ahead, sir.
Yes, sir. So the private money, are you really just using that in the equity portion of the financing in like the down payment aspect?
It depends on the deal, but yes, I have used it that way, and it's only on smaller, like JVs type projects. That's definitely not something for a syndicated deal, but I have utilized it for, let's call it, like a JV type deal. And I did
Okay,
personally guarantee the loan as well as had other assets to secure the loan as well outside of the real estate that the money eventually was used to purchase.
that makes sense. How are you making sure in those scenarios, especially even in syndication, that you're not over leveraged?
You really don't want to overstress the deal. Adhering to debt service coverage ratios is important, not just for the lender, but for you as well as an investor. I think that if you're buying it at 1.25, you really need to be careful about your expenses because, one small issue can really make a big, big dent in your total available net operating income to pay service debt and everything else. Um, yeah, stress testing your deal all along the way. Um, yeah,
Awesome, thank you.
and having a solid exit strategy as well, like knowing where you're going to replace that equity stack portion at the refi is really, really important. And making sure that you have a backup plan to your backup plan to your backup plan. Like what happens? Worst case scenario, this one doesn't work out. If you are a passive investor, you really need to be asking questions of the sponsor of the general partnership team that is in charge of the success of your deal. So you need to be asking these guys questions. Picture me being the investor. I'm asking these guys questions like, tell me what you're going to do to make sure that this deal isn't going to end up, back in the hands of the lender and I'm going to lose all my money. Well, one thing that you really need to ask is a lot of questions about the debt in those situations. Is the loan fixed or floating? It's a really important thing to know. Uh, and what's the DSCR and loan to value at the purchase? You'd be surprised how many deals were done on bridge loans that never should have, where they were negative cash flow day one and the loan covered the interest of the loan. It's crazy. And then they even had one where the loan covered not only interest on the loan, but it also covered distributions of the pref equity back to the investors. So it was literally just like a fully self-licking ice cream that just kept increasing the amount of debt associated with this property because they had some grand scheme that they would be worth double in 2 years. Or loan to value. Their bridge loans are in many cases 85% loan to purchase and 90% on the capex. That is a very, very, very stressed out, like very, very stressed loan. Your debt is just going to be through on that. Like if you do still have a 1.25 DSCR coverage ratio and buying a deal at 85% leverage and then also putting capex into it at 90% leverage, if it's still cash flowing, you got a great deal on that property, probably. Either that or you got very, very, very low cost debt that probably won't stay that way for very long. It's a honey trap, a bear trap. Like, you're Winnie the Pooh, and you are going to get caught with your hand in that honey jar. And a lot of people did and do and are right now today losing their deals to their lenders because of that, because they over leveraged their deal. Are there interest only periods? Is the only reason why this deal cash flowing because it's in an interest only period? Well, I hope not, because if it is and the interest only period expires, negative cash flow. Is a refinance or sale the exit plan? I mean, it's one or the other. But if it's a refinance, the question is, how are you basing your value of the property? What cap rate are you placing it on? How do you know you're going to be able to get there? What debt service coverage ratio constraint are you applying to that? And does that future loan come with several new and or increased expenses associated with it versus the current loan? For example, banks do not require you to carry 100% full replacement cost insurance coverage. They only require you to carry enough insurance to be able to pay off the loan and close out the, the value of itself. Like they don't insure all the way up. So you're going out of a bank loan and into an agency, better make sure that when you're refinancing into that agency loan, that the sponsor incorporates a interest or a an insurance product in there on that year for that loan. Those things are really important. Maybe you have extra some sort of rate cap that you have to go out and buy for hundreds of thousands of dollars. What are you paying for that? What does it get you? Yeah. What is the exit plan? And how is the debt associated with it? Is it, and if it's a sale, do you have any, do you have any yield maintenance or like a prepayment penalty associated with this loan? If we're going to sell it to another investor in 5 years, then and we're putting a 10-year loan on it, if the loan is not assumable and at a very good low rate, then how are you going to sell that property in 5 years if you have a 5-year business plan? Especially if we're going to probably pay some sort of prepayment penalty, and that costs money. Prepayment penalties cost extra interest expense and extra upfront fees, upfront costs as well. So make sure to understand what it's going to cost you to get out of this thing, because it could add up to hundreds of thousands of dollars, if not millions, in yield maintenance expense that some person just didn't understand, because it's a very nuanced industry. And believe me, no one reads every word of their loan docs. No one does. It's like a phone book. But as long as you understand every major aspect of your loan terms, and you make sure that those factors in loan terms are directly found in your loan docs, then you're probably fine. But no one reads them every word. And yes, there's always gotcha, and there's always a gotcha clause in a lot of places. So, and then asking that sponsor or investor, what happens when rates change, go up or down? How does that affect the property's cash flow? How does that affect the property's value? Have you taken that into consideration when you're talking about investing hundreds of thousands of dollars of my money? And if they can't answer those 5 basic questions, and with a solid understanding of what that loan looks like and what the terms of that loan look like and how those terms directly affect the returns on your invested dollar, don't invest with that sponsor. Find someone who is a true industry professional. There's a reason why you're doing this as opposed to going and just buying like single family houses or duplexes on your own, so that you work with somebody who's a true professional and understands these things. So I do these monthly live webinars in order to be able to create new friends. Thank you, everybody who has jumped in on live, but I have a question to ask you before we get into the Q&A. It is, if I've given you value, I would love to have you join our network. We call it Make It Happen Multifamily. And I really want to bring you into the fold. We do monthly in-person events. We do these live webinars. And in order for me to understand exactly where to kind of put you in the ecosystem, I need to know you. We need to book a one-on-one phone call. Let's get to know each other. Can I help you with where you're at in your investment journey? Ideally, yes. If you're someone who has more experience and can bring me value, please. I'm always looking for people to bring me value and vice versa. It's how the whole world goes round. So please, when you have a time, let's book a call. Let's get to know each other. And then when rates drop, the markets move really fast, and it's going to be time to make moves. And let's make moves together. and from a very intelligent and focused and specific goal-oriented plan or pattern. All right, drop your chat questions in the chat, or you can just jump off mute and ask questions. I mean, I'll answer anything that I can. I am not a loan broker. I am not a lawyer or an accountant, so I can't give any like specific advice, but I can give you the advice of someone who has done a bunch of different loans, on $80 million worth of real estate.
Lee, so how are you, could you go into a little bit more about cap rate and how you determine the cap rate?
Yep. So cap rate is it's an industry factor utilized by brokers and appraisers to determine the value. It's based on a number of factors, but essentially what it is the risk adjusted rate of return that someone is willing to take when buying a certain asset class or a certain asset. So the higher the risk, the higher return you're going to want to have, and the higher the cap rate at the end of the day. So yeah, and if you want to determine the value of a property, you need the net operating income, and you either in order to figure out the cap rate, you have to do net operating income divided by the purchase price, which is your cap rate, or in order to determine the purchase price, you can take the net operating income and multiply it by the cap rate, and that gives you your purchase price. Or you have, if you have the cap rate and the purchase price, you should be able to then, if you multiply cap rate by purchase price, that'll give you your NOI that the property should have.
Okay, so NOI, purchase price, and cap rate are all synonymous or work congruently.
Yep. So you have, where's my thing here? So you have NOI or value,
If you're drawing something, it can, oh, never mind, it's showing up now.
right? So your NOI divided by the cap rate equals your value. So if you have we'll call it a $1 million property or $1 million NOI, and it is a 8 cap property, divide that by 0.08, it's a $12.5 million property. And the math can go back and forth in both ways.
Oh, thank you.
Yeah, no problem. So yeah, anyways, any other questions? Burning heart's desires.
Do you think
Hopefully,
that multifamily, oh, sorry, go ahead.
yeah, go ahead.
So do you think that multifamily commercial investing is a avenue or strategy that people with little equity or little net worth can get involved into?
I mean, absolutely is the first answer. But one of the best teachers, I have the pleasure of being a partner on a mastermind with probably the best personal finance teacher that I know. And he put it really nicely in our meeting last month. You can either provide one of three different things. You can provide time, you can do treasure, or talent. You can provide all three. And if you have all three, then absolutely you're a winner all day long, and you can just go off and do as many deals as you want, unlimited purchasing, just continue to go buy as much as you possibly can. But if you can only give two things, like let's say you can bring treasure and you can bring talent, well, but you have no time, you can take that and go train somebody else how to do what you do and provide your cash, and then you can go ahead and do as many deals as you might want. Or you can provide just one of those things. Obviously, you're talking about not providing treasure. So now you're talking about time or talent. So can someone with time and talent find someone else who has treasure and go be an owner of and or operator of commercial multifamily? Absolutely. But if you're not willing to dedicate the time to it, talent won't really matter that much unless your talent is to teach other people how to do it or to do it yourself at the end of the day. But if you got treasure, you can be in for sure. But treasure with no talent and no time doesn't get you the deal. or all the time in the world, but no talent, no treasure, oh man, you're not really getting there very far either. So that's why getting educated is really important for people who are getting started in the industry and attending things like this. Is because ideally you want to be able to provide two of the three things. And if you can provide time and talent, finding other people who have treasure is, I don't want to use the word easy, but if you focus on it, it will definitely happen. And I've partnered with many young people who have brought only time to the deal and then allowed me to shape their talent in the process of their growth in the business. And then between my, my and my partner's treasure, we were able to go buy, millions and millions of dollars worth of real estate. So can you do it? Yes. Is it immediately happy go lucky rewarding? I feel like $1 million. No, because you're still trading your time for one day maybe treasure. In fact, it's even in some cases a harder thing to get into and do and commit to because you don't see the reward for your time. I've had multiple conversations recently with people who got in early, got in and started doing bigger deals quickly, took small pieces of big deals and weren't making any money at it, but were dedicating lots and lots of time to it. And it gets extremely frustrating because it takes years for these deals to pay off for those guys who are just putting in time. Because you're basically just banking your return on investment, which really it's not an investment. It's a job. Syndicating is a job. Investing is being a passive investor. So if you want a new second job, jump into multifamily real estate syndicating all day long. It'll increase your net worth over a long period of time and cost you nothing. You can be a part owner of a multi-million-dollar asset all day long. So why do I do this? Once again, is to be able to book calls with everybody who's here live or on the Facebook Live, or I do record these and post them to the YouTube channel. So yeah, please do schedule a call. Use the QR code, book a call with me, 15, 30 minutes. And let's find a way to fold you into the ecosystem, whether you're a passive investor or somebody who's looking to get in on their first deal by providing time, or talent. I'd love to talk to you and see how I can help you, adding value to the universe.
Thanks, Lee. Appreciate it.
My pleasure. Hope everybody enjoyed our webinar this month. I hope you're having a great week so far. And just as a reminder, this Thursday is Tours and Pours. So if you have a chance, you're in St. Louis, and you have a chance to make it out for Tours and Pours this month, would love to see you there. 6 o'clock on Thursday, the 14th. We're going to be touring a 6-unit in Soulard, learning from the owners about their recent purchase of this property, how they got it across the finish line, and what they're going to do to it next. And then we're going to go interview them at Schlafly Tap Room down by the soccer stadium. So hope to see everybody there who's here in St. Louis. And I hope everybody has a great, amazing rest of their week. Please book a call. That's why I do this thing. And let's get to know each other. All right.
Thank you. Have a good night.
Thank you.
Thank you for joining, everyone. My pleasure. Bye-bye.